Remember, you can have a great deal, but if the structure is not right at the wrong time, the deal isn't going well, your interest is not protected.
Welcome to the American Dream Builder and Investor Podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is, the trinity of freedom: time, financial, and geography freedom. I'm your host, Micy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same.
Hi there. Welcome to another episode of the American Dream Builder and Investor Podcast. Today, we'll continue on to our last part of the due diligence series, where we'll talk about some of the questions you can ask internally, or some of the questions you can think about in your head, or ask the sponsor in regarding the deal structure. So I do want to remind you that if you have looked at any of the deals, you know that we typically start with a presentation or a one-pager that talks to you about the deal structures, how things works. And it's always important to verify all the structures in the document, in the legal document that you'll be signing, because those PowerPoints are more of a summary, but then the actual legal documents you sign is where it finalizes everything. Because it can tell you what your returns are, how the splits are, how the distributions are done, and any of the fees. So it's very important to read those 100 pages carefully. I wouldn't say all the sections are equal, but definitely the sections about who's involved, what are the return structures, how often are the distributions, some of the things we just mentioned. So you want to understand when you're reviewing the deal structure, what is a preferred return. I did go over in the previous sessions that a preferred return is where the returns are 100% going to you, the passive investors, before the general partners or the sponsors taking any percentage of the return. So if you have 8% return, that's preferred, and it's a 5-year hold. So that means 8% per year for 5 years, which is 40% returns, goes straight to you before there's any splits. Let's say the split after the 8% return is 70-30. So typically that means 70% going to limited partners and 30% going to the sponsors. So hopefully that makes sense. And you also want to understand, is the preferred return cumulative? Meaning if you didn't hit the 8% return that's preferred in year one because cash flow only went to 5% in year one, will you be able to catch up that 3% difference in year two? Right? You can usually have them explain an example and explain it to you, or just document that, make sure it's documented in the PPM private placement memorandum as well. You want to understand what's the cash on cash return versus what's the overall return. I sometimes see people just lump the overall return in one number. Oh, overall, you're going to double your money in 5 years, and the cash flow is like 2% per year. Then so much risk is waiting until 5 years later. Who knows how the market is at that time? So you want to understand what's the split between cash flows versus appreciation. So cash flow versus when you sell the property, and place your risks accordingly. And this is not to say that it's not a good idea if there's no cash flow for a few years. I'm just saying that going in there, knowing how the distribution looks like, right? You also want to understand the waterfall structures. There's so many different ways to structure the opportunities. And some of the standard ways mentioned is a preferred return, and then just a waterfall split. But sometimes there's also another waterfall after 8% pref or 6% pref. So, for example, it could be a 6% pref, and then after that, it's 80-20 split like we talked about. And then until it reaches, let's say, 50% IRR or 50% average annual return, and then you may go to a 50-50 split. So that's just a structure that the sponsor may have. And a lot of times they have those structures is to further incentivize sponsors to get to higher returns. Or it may just be a way that a sponsor feel that best justifies the returns that they need to get for their efforts involved. Or that may be the way they see is a reasonable return to the investors. So that's just different ways to structure the deal. Something that I wanted to share with you to look for and understand the different levels of the waterfall. And sometimes the returns changes after a refinance takes place. And I know opportunities that are like that. They may give investors a lot more return at the beginning. Maybe all the cash flows goes to the investors until refinance takes place. And then the sponsor take a larger percentage of the cash flow. And a lot of times the reason for that is throughout the refinance, a lot of the investors' capitals are returned, if not all of them. So there's really not much capital at risk. So the sponsor and the investors are both enjoying the fruit of the labor a lot more. And the other piece about the structure is also related to, can you transfer shares? In most of the syndication investments, they can't really transfer shares, but sometimes sponsor may allow you to do that, and that will be documented in a private placement memorandum as well. You also want to understand, where are the fees coming from? Is there a asset management fee for the sponsors to manage the property management company and the overall asset to make sure it's performing to the plan? And also, is there a acquisition fee, meaning that's a fee to compensate the sponsor's team to find the property, and also to put it through contract and close it, right? Is there a refinance fee? Is there a capital transaction fee? I'm mentioning a lot of fees, but not everyone's going to charge all of them. And I've seen people who doesn't charge any of them. So it just depends on how the sponsor is structuring their returns. At the end of the day, you want it to be a win-win situation so they can thrive and you can thrive too and continue to grow the long-term relationship together.
This podcast is sponsored by Life Mission Capital, founded by me, Micy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
You also want to understand if there is any co-invest by the general partners, and ideally more than the amount of money that they'll be making on the acquisition fee. So you know that they're actually investing their own money into this deal and they really believe in the deal as well. Another thing is about the depreciation. We talked about tax benefits, right? It's one of the most powerful things about real estate. You want to understand how much of the depreciation is actually passed to investors. Sometimes some of the investors don't need the depreciation, like some of the preferred partners. Some of the preferred equity partners, sometimes the common equity partners actually get way more of depreciations because of that. Or sometimes the general partners take certain shares of the depreciations, so investors wouldn't get as much. So you want to understand all of those as well. And also, what is the reporting requirement? This may or may not be documented in the private placement memorandum, but it's something you want to understand. How often are you going to hear back from them? Whether it's distributions, reporting, and what they're going to cover in the reporting. Are they going to share the P&L? Is there any auditing going on? Sometimes in the bigger fund there is, but a lot of times in the smaller fund, smaller project, there's not a lot of auditing going on. So you having visibility to some of these numbers are important as well. Will all the partners have access to the financials, right? Having multiple hands in the same area can always ensure checks and balances in numbers to make sure we have even more confidence on the numbers it's producing. And under what circumstances do the investors get to vote? In a lot of cases, investors don't have any rights to vote, but in some cases, on key decisions like overthrowing a certain member of the sponsor team, if they actually turn out to be breaking the law or doing something illegal, sometimes in the PPM document, it gives investors the right to vote and select different operating partners. And also, how's the asset management fee calculated? Is it based on gross income or net operating income? Can be quite a difference, right? So I'm not going to go through the complete list, but I think some of the things I mentioned are critical ones. Another things I can think of is capital call, right? What happens, for example, in the last 6 months between Q2 2022 to now, interest rate has rapidly increased, basically increased about 300 basis point, if you can say that, 2 to 300 basis point in the commercial real estate space. And if you have a bridge loan on variable rate, you may be having to do a capital call because your interest payments are so much higher, so you need more capital injected into a deal. So when that happens, what happens to investors who don't want to contribute to their shares just get diluted? Or what happens? Is it necessary for them? Is it necessary for each investors to contribute? Will the investor continue to be a owner to the deal? So never assume. Always read the documents or get clarifications. And at the end of the day, you'll be signing your names on a piece of document that outlines all this. So ask questions that's needed with the document. And hopefully that will help you answer the questions you have. Remember, you can have a great deal, but if the structure is not right at the wrong time, the deal isn't going well, your interest is not protected. And that's one of the reasons insurance they do so well is because insurance, we only need it at the times of difficulty. So we want to make sure what we want to get protected, whether it's this level of coverage or that level of coverage, is really outlined well. So same thing with the structure, the legal documents, you want to read through it, especially the key sections we talked about. So hopefully that's helpful. That's wrapping up the due diligence sections with the last sections on legal structures. Thank you so much again for being a loyal listener of the American Dream Builder and Investor podcast. I'm looking forward to seeing you in our next episode.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Micy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.